What if the loudest political fights you see are not where the real money decisions are being made? From 2018 to 2020, Trump's trade war with China dominated the news. Tariffs were slapped on hundreds of billions of dollars worth of Chinese goods. Headlines screamed about standing up to Beijing. Both parties talked tough about bringing jobs back home. The political establishment spoke with one voice, saying America was finally going to push back. Before we go any further, if you want clear explanations of how power and money really move behind the scenes, subscribe to this channel and turn on notifications. These patterns only make sense once you see them early. Now here's what happened quietly, away from the cameras. In those exact same years, BlackRock, JP Morgan, Goldman Sachs, and the rest of Wall Street moved about $1.4 trillion into Chinese markets, roughly $105 billion a year, building up to that $1.4 trillion figure, with the peak year being 2020, right at the height of the trade war. That is not a coincidence. That is timing. You might think this was a mistake, bad luck. Maybe Wall Street misread the politics. Maybe they were blindsided by the rhetoric. That sounds reasonable until you understand the pattern. This move was one of the most predictable actions in modern financial history. There is a cycle, repeated for more than 300 years, so consistent that once you recognize it, the current shift in American economic power becomes obvious. Right now, we are in stage 3 out of 4. The global financial system is not random. It is not chaos. It operates through a 4-stage mechanism that has ended every reserve currency we have on record. Stage 1 begins when financial elites create a monopoly over money creation through a central bank. This gives a small group control over how money enters the economy. Stage 2 follows when that monopoly is used to finance government expansion through debt. Spending increases, growth looks strong, and the empire spreads. Everything appears healthy. People believe the system has been perfected. Stage 3 is where strain shows up. The system stretches too far. Currency starts losing purchasing power. Government control weakens. Small cracks form that most people ignore. Stage 4 is the key move. The same insiders who designed the system quietly move their capital into the next rising power. Before collapse becomes obvious, ordinary citizens are left holding paper that no longer holds value. We have already seen this play out. Britain, Germany, America after 1971, and it is unfolding again today as Wall Street channels money into China while Washington performs toughness for the public. Start with Britain. The country is at war with France and nearly broke. William Patterson proposes a solution. Create the Bank of England. The government borrows £1.2 million at 8% interest. The brilliance is not the loan itself. The government issues debt. The bank turns that debt into circulating money. Wealthy subscribers earn interest on the entire money supply. Stage 1 is complete. The results are fast. Within 4 years, Britain's national debt jumps from 1.2 million to 16 million by 1815. After financing the Napoleonic Wars through debt-backed money creation, the debt reaches 885 million. The lenders do not just profit, they effectively control the government. Stage 2 follows naturally. Britain builds the world's largest navy, colonizes vast territories, and the pound becomes the global reserve currency. Trade runs on pounds. Foreign governments store pounds as reserves. Britain looks unbeatable. But underneath the surface, problems emerge. By the mid-1800s, British industrial output peaks and begins falling behind Germany and the United States. The cost of empire grows faster than revenues. Debt rises again. At this point, the same financial interests begin shifting capital to America. British money flows into American railroads, steel, and factories. By the time Britain abandons gold in 1931 and the pound loses reserve status, the system has already been rebuilt in New York. Stage 4 executed cleanly. Next, Germany after World War I. The Treaty of Versailles imposes 132 billion gold marks in reparations. Germany must choose between crushing taxes or printing money. The Weimar government prints. The Reichsbank monetizes debt, pays workers, and funds social programs to maintain political stability. When France and Belgium occupy the Ruhr in 1923, Germany pays striking workers with newly printed marks. The numbers spiral. In May 1923, 8.6 billion marks, June, 17 billion, August, 669 billion, November, 400 quintillion by November. $1 buys 4.2 trillion marks. Wages lose value within hours. Savings vanish. The middle class collapses. This was not accidental. Reichsbank President Rudolf Havenstein bought foreign currency at any price, destroying the mark deliberately. Inflation erased debts and reshaped society. When Germany stabilizes with the Rentenmark, recovery depends on American loans. The Dawes Plan brings Wall Street into Germany. U.S. capital restructures the system. When collapse follows in the early 1930s, American institutions are already positioned for the next shift. Same structure, same outcome. The third example creates the system we live under today. Bretton Woods, New Hampshire. Delegates from 44 nations design a new order. The dollar is pegged to gold at $35 an ounce. Other currencies pegged to the dollar. Central banks can redeem dollars for gold, backed by Fort Knox. The dollar becomes the global reserve currency. For 2 decades, it works. Europe rebuilds. Japan recovers. The dollar flows everywhere. American economic dominance looks absolute at this point. The United States sits at the center of the global system, but then something subtle changes. The U.S. begins using its privilege as the issuer of the reserve currency to fund massive commitments without raising taxes. The Vietnam War, the Great Society programs, the Cold War military buildup, all of it paid for largely through money creation rather than direct taxation. Here's how that works. In simple terms, when the government spends more than it collects, someone has to fill the gap. The Federal Reserve steps in by expanding the money supply. Interest rates are kept low. Borrowing feels painless. Growth continues. On the surface, everything looks fine, but those dollars do not disappear. They flow outward. As America runs larger trade deficits, dollars pile up. Inside foreign central banks, by 1971, the imbalance becomes impossible to hide. There are far more dollars in circulation than the U.S. has gold to back them. Some countries notice. France, under Charles de Gaulle, begins demanding gold instead of paper dollars. In August 1971, President Georges Pompidou sends a battleship to New York to collect France's gold. Switzerland exits the system on August 9th. On August 11th, Britain asks for $3 billion worth of gold, moved from Fort Knox. Paul Volcker, then Undersecretary of the Treasury, and later Paul Volcker, explained what that moment meant when Britain, the nation that helped design the system, and once defended its own currency at all costs, started demanding gold. Insiders knew the game was finished. By August 15th, only about 10,000 metric tons of gold remained in U.S. reserves. That Sunday evening, August 15th, 1971, President Nixon goes on television and announces the United States is temporarily suspending dollar convertibility to gold. The gold window closes, temporary. In theory, permanent. In reality, Bretton Woods collapses. By March 1973, the world shifts to floating exchange rates. The dollar becomes pure fiat, backed not by gold, but by government promise and U.S. military dominance in global oil markets. The result is measurable. Since 1971, the dollar has lost over 98% of its value relative to gold. Gold moves from $35 an ounce to over $3,000. This is not random inflation. It is the same pattern again. Overextension, loss of discipline, currency debasement. Now apply this framework to the present. July 6, 2018, Trump announces tariffs on $34 billion worth of Chinese goods. The trade war officially begins. The message is clear. America is finally standing up to China. Manufacturing will come home. Trade will be rebalanced. Both parties support it. The establishment appears united. But July 6, 2018 matters. For another reason, it comes exactly 1 month after June 1st, 2018, when MSCI officially begins adding Chinese A shares into its emerging markets index. This sounds technical, but the effect is enormous. When MSCI changes an index, institutional investors have no choice. Pension funds, sovereign wealth funds, university endowments, insurance companies, trillions of dollars that passively follow the index must move capital into whatever is included. China's weight in the MSCI Emerging Markets Index jumps from nearly 0 to 43% by October 2020. At the same time, between 2018 and 2020, U.S. portfolio investment into China reaches $1.4 trillion, with the peak in 2020, right as the trade war is at full intensity. Look at what the largest institutions are doing. BlackRock expands its Chinese operations. Throughout this period, J.P. Morgan secures approval for a majority-owned securities business in China. Goldman Sachs increases its stake in its Chinese joint venture. These are not missteps, they are coordinated outcomes of the same structure seen before. Check the boxes. U.S. national debt sits around $36 trillion. Debt to GDP is near 98%. The Federal Reserve balance sheet grows from under $1 trillion in 2008 to $9 trillion during COVID, and remains above $7 trillion. This is the same mechanism repeated. Central bank monetizes debt. Government spends beyond taxation. Currency supply expands faster than productive output. Stage 1. Federal Reserve, created in 1913, monopoly on money creation. Stage 2. Decades of debt-funded wars and programs. Stage 3. Overextension, high debt, currency debasement. Stage 4. Financial capital migrates to the next power center. That is where we are. The pattern does not care about politics. It does not care about belief in American exceptionalism. It does not care about technology, modern monetary theory, or stories about why this time is different. The mechanism is mathematical. When money is created through debt, when spending outruns production, currencies lose value. When that currency is the global reserve, insiders move first. Here's what most people miss. The trade war was theater. It created the appearance of resistance. While financial integration accelerated underneath, you cannot fight China with tariffs. While your largest financial institutions are building China's capital markets, you cannot reshore manufacturing. While index providers are increasing China's share of global portfolios, you cannot preserve dollar dominance while financing trillion-dollar deficits with central bank money. This contradiction is not a mistake. It is the mechanism itself. The British public did not realize, in 1880, that their capital was building America. Germans did not realize, in 1929, how foreign finance had shaped their collapse. Americans today do not see Wall Street building China's financial infrastructure, while Washington performs resistance. But the pattern does not need public awareness to function. So what do you do with this? You recognize the machine is already moving. You understand that by the time this becomes obvious to the mainstream, repositioning will be complete. You accept that the dollar's reserve status and American financial dominance are not permanent. They are part of a four-stage cycle, and you position yourself accordingly. You understand something most people never stop to question. Holding assets denominated purely in a debasing currency is not neutral. It is a decision. It is a choice to participate in a transfer mechanism that quietly shifts purchasing power away from you over time. Here's what that really means. When a currency steadily loses value, anything priced in that currency buys less real goods, less labor, less energy. Inflation is not temporary, it is not transitory, it is not mainly caused by supply chain issues. Those are surface-level explanations. Inflation is the predictable outcome of monetary expansion. That grows faster than productive output. More money, same or weaker production, higher prices. The math is simple when you are told not to worry, that this time is different, that modern financial engineering has solved the problems that destroyed earlier systems. There are only two possibilities. Either the person saying it does not understand the historical pattern, or they understand it perfectly and benefit from its execution. There is no third option. Take a moment here. If you want to keep seeing this explained calmly and clearly, without noise or political spin, subscribe now and turn on notifications. This next phase only makes sense if you are watching it unfold, not reading about it afterward. The next 5 to 10 years will not resemble the last 30. That is not a guess. The mechanism is accelerating. The debt cannot be repaid. In real terms, it can only be rolled, inflated away, or restructured. As that happens, the currency continues to debase. The financial elite are not waiting around to see how this ends. They are already positioned. The real question is not whether the pattern will complete. It always does. The question is whether you understand it clearly enough to recognize it in real time and make decisions that account for the outcome before it becomes obvious. to everyone else. This is not prediction. It is pattern recognition. The same mechanism that moved British capital into America in the 19th century, the same mechanism that moved American capital into Weimar Germany before its collapse, the same mechanism that moved capital out of the United States as Bretton Woods failed, is now moving capital into China, different era, same structure. While politicians argue over tariffs, while think tanks debate decoupling strategies, while media panels obsess over trade war optics, the real decision has already been made. About $1.4 trillion has already moved. Capital does not wait. For press conferences, it moves. When the incentives align, and the pattern, which has never failed to complete itself, is roughly 3/4 of the way through execution. If you want to understand what happens next, you cannot start at the headlines. You have to understand how the machine was built in the first place. You need to see the institutional architecture that makes this transfer possible. Central banks, reserve currency privilege, debt monetization, index-driven capital flows. These are not abstractions. They are the gears. Every historical parallel points to the same outcome. The population continues to hold the currency as its purchasing power collapses, while the architects of the system have already moved their wealth to the next power center. That is not cynicism. That is history, repeating its structure. That is the pattern. That is the mechanism. And that is what is happening right now, while most people focus on political theater and miss the systematic wealth transfer occurring underneath it. Subscribe now if you want to see how this machine was built, how it actually operates in practice, and what the completion of Stage 4 looks like when it arrives, because it is arriving. And unlike every cycle before this one, you still have the chance to recognize the pattern while it is executing instead of understanding it, only after the collapse is complete.